So the rest of this chapter is going to be based on funds used for construction and how we can capitalize interest in construction projects as well as the funds used in construction. And then we're going to look at research and development expenditures, how we classify research and development expenditures. And you're going to see that except for very limited costs, we'll expense most of the funds in research and development through the income statement. Some of them will be capitalized, but for the most part, they're going to be expensed up to certain thresholds of interest. And then we'll look briefly at software development costs and how we can capitalize software development and how that differs slightly from research and development. So the interest costs during the construction period are going to be able to be capitalized. Anything that we borrow, and if you can imagine, if we are self-constructing an asset, we are most likely borrowing a good amount of money in order to fund that construction. However, even if we don't specifically borrow funds for construction, we are still spending money that could indirectly be related to funds that we've borrowed. So the example I give is that, we would have normally paid our employees out of the cash we have in the corporation, but we use that cash for construction. So therefore, we're going to have a need of more cash to pay our employees since we are directing those funds toward construction projects. And then any money we've borrowed then becomes indirectly related to the construction because the construction created this need for additional funding. So this allows us to actually capitalize certain costs in construction. And of course, when we look at the capitalization procedure, we know already that if we have non-capitalized interest, this is what it would look like, of course. Interest expense, either interest payable or paid during the period, credited, right? A reduction to net income and a increase in the liability. Capitalized interest on self-constructed buildings is going to be added to the value of buildings, right? So we have a lot of expenses going in here, materials, labor, indirect, direct costs. This, of course, increases the asset. And if we're adding in the interest, then we are going to be able to add that interest temporarily to the building and defer the expense. This, of course, will either increase a liability or decrease an asset, depending on whether we use a payable or whether we actually pay the cash outright. So the interest cost incurred during construction will be capitalized and then depreciated. We've talked about this before, that capitalization does not avoid expenditure. We're just altering the timing of the expense. We're deferring it over a period of time rather than recognizing it now. Once construction is complete, then interest goes back to being expensed as our usual procedures. So what qualifies? Assets that qualify first have to be examined. So it has to be an extended period of time to get them ready for use. Assets under construction intended for the enterprise's own use. So if you're not in the construction business, but you are constructing a building, this is still something, if you're self-constructing, you can qualify an asset that you are self-constructing. If they're intended for sale or lease, so then now we are a construction company, we are constructing the asset and producing it for sale or for lease, real estate developments, commercial real estate, ships, etc. Defense contracts, ships. Capitalization period. So what period of time can we actually capitalize interest? It begins when we meet three conditions. So we have to meet all three. This isn't one of those, accounting conditions where only one has to be met. However, now we have to have three conditions met. Actual cash expenditures have to have been made, money paid to contractors. So not just accrued expenditures, right? But actual cash flows. Real activities. So we can't just have spent cash, but be holding back on the actual blood, sweat, and tears part of it. We have to have broken ground. So actual real activities have to be in place, and interest cost is being incurred. So this is probably the most obvious one, that in order to capitalize interest, we have to have some interest, right? And again, that doesn't have to be specific interest. It can be non-specific interest. The capitalization period ends when the asset is substantially complete and ready for its intended use. So how much can we capitalize? Capitalization of interest is going to be capped at one of the amounts. It's going to be the maximum of total interest expense, right? So whatever the total interest we would have recognized for the period obviously creates a ceiling for the amount of capitalization that can occur on that interest, or the amount of construction costs that actually qualify for capitalization. And so we're going to look at this, and in order to determine the amount of construction costs that qualify for capitalization, we're going to create a measure called the weighted average accumulated expenditures. So we can't go above the total interest expense we had during the period. Again, that's a little obvious of a maximum. But then we also can't go above the weighted average, forgot the ED, weighted average accumulated expenditures of the project. So I just kind of say, oh, well, look at this, right? We have a big square, and then we can separate it out into construction costs that qualified for capitalization. That's what we would debit to the asset after weighting it appropriately by the rate. And then we would have some leftover interest expense. But oh, look what happens, right? When construction costs that qualify for interest capitalization are greater than the total interest expense that I have, well, then we just debit the total interest expense to the asset, right? And that E should be down here. I don't know why it floated. I don't like doing graphics in Word. It's rather not easy. Steps to compute capitalized interest. So the first thing we want to do is get that average, that weighted accumulated average expenditures. That we want to see what costs actually qualified to potentially be capitalized. And so in order to get that measure, we just want to weight each expenditure by the fraction of the construction period that it can incur interest. So, for example, if I started construction on September 1st, right? So if I start on September 1st, then I have, that's kind of glaring and odd. Okay, there it goes. That's better. If I started on September 1st, then I have September, October, November, December. So I have 4 months in my construction period. And I say 4 months, I'm typically going to assume a December 31st fiscal year end. All right. So that means that, from the time I broke ground to the time that I'm reporting, there are 4 months. Right. So this 4 months would be the total amount of time an expenditure could accumulate interest. So if I have an expenditure on September 1st, I would rate it for a 4 for a 9-1 expenditure. If I had an expenditure on November 1st, it only has 2 months, right? So whatever that expenditure is, it's only been outstanding for half of the construction period during this reporting period. And so it will only get a half weighting. And then 1 of 4 for December 1st. And then if it was say on December 31st, it would get no weighting whatsoever, 0 of 4. After you've weighted each of them, I kind of just, talk through that in these 2 bullet points here. But after you weight them, then you sum them up after assigning an appropriate weight to each expenditure. You want to determine then, after you have your WAAE, you have an amount of expenditures you can apply interest capitalization to. So the next step is just to determine the source of the expenditures and the interest rates attached to each source. So remember, of course, we are limited by the weighted average annual expenditures and the debt we have available, the total interest expense we're going to recognize. If the weighted average expenditures are less than or equal to that specifically borrowed for construction, then we'll apply specific borrowings first, so those get priority. We apply all the amount of specific borrowings we have, we determine the interest rate there, and then we start to apply those that are just generally outstanding debt amounts that have their own interest rates. If the weighted average accumulated expenditures are greater than the debt, let me back up. I flipped these two scenarios. I said that if the weighted average accumulated expenditures are less than or equal to the amount specifically borrowed to finance construction, then all we can do is apply the specific borrowings. That will exhaust it. There's no more weighted average accumulated expenditures. And so we do not apply any outstanding debt that is not specifically applied. Now, down here, we do have more accumulated expenditures than debt specifically borrowed. So first we apply the specific borrowings, and then we apply a weighted average of interest rates incurred on all other outstanding debt during the period. So, we might have, after we exhaust all of the specific borrowing on our accumulated expenditures, and we say, oh, look, we still have another, say, $400,000 that we could use to capitalize interest after we've applied all of our specific borrowings. Well, then we're going to say we have a portfolio of loans. They're at different interest rates. I get a weighted average interest for the total amount of that loan portfolio, because maybe some are at 8, some are at 6, some are at 4. I get a not a true average, not a simple average, but a weighted average of those loans. And then I can apply that to the remaining $400,000 that was not specifically used in the was not used by the specific loans that we borrowed for the construction project. So let's look at this example. A company is constructing a new building for $2 million in total. They have the following schedule of expenditures. Construction was complete at the end of 2006. It began in April of 2006. So if we began in April, then we have 9 months that are going to be our construction period. Which means that all these expenditures will be weighted on a 9-month basis. So if we spent some money on April 1st, $500,000 on that date, then on that date, the $500,000 would be weighted at the full 9-month period. It's been outstanding the entire time, and so it will receive a full weighting. And then we go to the June 1st payment. It's $700,000. June 1st, we have 7 months until the year end, so that would be 7 of the 9 months. And then that would give me 700 times 7 divided by 9. 700 times 7 divided by 9. And then on August 1st, we have a $600,000 payment. That August 1st would be 5 of the 9 months considered in construction. One of those fun repeating decimal places. And then the 12/31, because it was spent at the very end of the year, receives no weighting. And then all we do is accumulate these, sum them. So 333, 333 plus 544, 444 plus 500 gives me 1,377,777. Okay? So that is my weighted average annual expenditures. Weighted average accumulated expenditures. Right? So this is the cost that could qualify for construction because of the time that they've been outstanding during the year. Now we go to figure out what is the debt. That's step 2. Suppose the company had borrowed $800,000 specifically for this project, right, at a 7% rate. It had other non-specific borrowings of $1 million. So now we need to look at, with this amount that we just determined, 1,377,777, how much of it is going to be covered by what amounts? Well, first, again, we want to apply the specific borrowings at 800,000. Clearly, we have more than that. 577, 777. We want to multiply that 8%, or that 800,000 by the 7% rate. And then we have to weight that annual rate of 7%. Because it's only been outstanding since April 1st. So we weight that, because this is an annual number, by 9/12. And so we can figure out then the amount of interest we can capitalize on the first debt offering, right, is all the interest I would have recognized on this specific debt anyway, right? If I had asked you, what is the interest expense that is going to accrue from this 800,000 at 7% that was issued on April 1st, this is just the formula you would have given me. So because our weighted average annual expenditures are over that amount, we can then capitalize the full amount, which comes out to 42,000. Then the 577,777, we would take a look at the non-specific borrowings we have, which is $1 million. So we certainly have this covered, right? We can cover, because it's $1 million is more than 577,777. I tell you that it has a weighted average interest rate of 8%. Now, how long have these non-specific borrowings been outstanding for? I don't tell you specifically, but I will, let's just assume that they've been out for the whole year. And that would mean that we can charge the entire 8% rate to those, 577,777 times 0.08. It would be 46,222. Which means that we can then capitalize $88,222. So that's the amount we can capitalize. Now, how much do we expense at that point, right? So the question of how much do we expense would be answered by saying, all right, this is the amount that I had that I applied with the 1 million. So there's only going to be, since I applied 577,777 to that, I have 422,223 remaining. That is the interest, that is representative of principal that is not going to get a capitalized treatment. Which means that I'll end up expensing $33,778 after I've rounded. So that's going to be capitalized to building. And this is going to be expensed as interest expense, of course. We'll look at other ways you can do that, but this time it was pretty simple just to apply it that way. Scenario 2. Suppose that instead of having $1 million of non-specific borrowings, we only had 200,000. Well, so in that case, if I restrict it, right, this still applies because I had that specific debt. So I'm still capitalizing that amount. So I still have $42,000 of capitalized interest from the specific borrowings. Now I would apply the non-specific borrowings to 577,777, but now I have a case where my remaining 577,777 is obviously greater than the $200,000 of debt that I have to capitalize. So I can only take the maximum of that amount. So that's the amount that I would apply capitalization to. I would be able to capitalize the full amount, obviously, because I have far greater weighted average expenditures than principal. And it's been outstanding for the entire year. So that would just result in 16,000. And that would be then capitalized interest and capitalized interest. They're off kilter. So just to let you know that both of those will be capitalized interest, and that would sum up to $58,000 of interest that could be capitalized on this project. All right. Now, how much interest expense do I have? I would have zero because I've capitalized all of my interest expense. I capitalized everything in the 800,000. I capitalized everything in the 200,000. So I would have $0 of interest expense for the period. Okay, so we'll look at a few more problems in class and make sure we have that buffed up. One thing to know is that if construction continues past the end of a reporting period, then the procedure is that we take all the costs that have been capitalized, that's all the material, labor, all of the interest costs. So basically everything that's in your constructed asset account at the end of the year, and that's going to be that's going to be treated as a January 1st expenditure if we're a December 31st company at the beginning of the next period. So that's going to get a full weighting in the following period, no matter what the construction period is. So maybe we finished it up at February 28th, it would get a 2 of 2 weighting, right? Anyway, it gets the full weighting. Special issues related to interest costs. Interest costs incurred in the purchase of land to be used as a building site, not the land's cost. So capitalize this to the cost of the building. So that would be part of the building's cost. Interest cost incurred on land being developed, however, for a lot sale, for example, for planning some sort of a development, some sort of housing development, that's going to be included in inventory because this represents something that's going to be sold. We're going to develop the land and we're going to sell it. And the resulting interest cost would be, the improvements may be funded by debt and the resulting interest cost would be considered for capitalization. So that would actually be going into COGS when we sold it. Interest revenue earned on funds borrowed to finance the construction of assets are not netted against interest expense incurred. So if we borrow some money, we have surplus money left over, we invest it in certain investments that will earn interest revenue, we don't get to net those costs. Just little caveats about it. Startup costs. Startup costs are a sort of expenditure that you might not think necessarily relate to what we're talking about. I mean, in some ways it could. We're constructing something new. But anything that's associated with new product lines, new business segments, new business locations are going to be expensed, not capitalized. And, so you got to be a little careful with what you're talking about. I'm not talking about buying a building in a new location or constructing a building in a new location. Those would certainly be capitalized. But yeah, I'm talking more about research into new product developments, the cost of trial runs or, soft openings, the expenses that go along with those items, prototypes for new products, training and staffing for the openings. So, we're talking about the flows of costs, not the assets that you're procuring that will still be established when the business has started. Okay. And the same sort of logic is put into organization costs when you start a new or you incorporate an entity for the first time. There's going to be legal costs, states and filing fees, things of that nature, just to establish your corporate brand. Then you're going to have those be just generally organizational startup expense. Research and development. This is a big topic, and it's a growing topic because, as I said before, our economy is becoming increasingly intangibles based. Research out there shows that intangibles represent a larger and larger part of the balance sheet for many companies. And actually, we see a lot more imprecision in the relationships between net assets, profits, and stock price. And a lot of it seems to be due to investors' inability to really disentangle what's going on with research and development, the sometimes unclear disclosures that surround intangibles, and the mystery just revolving around like, what is the fair market value of an intangible? Especially when the book value is, in a lot of its cases, so unhelpful to determining that amount. So the research and development costs. Research is an attempt to discover new knowledge, right? You're hitting the books, you're looking up articles, you're delving into the science journals to hope to be inspired to accumulate knowledge that you can then apply. Development then is that application, the translation of knowledge to the product or process. You're going to expense all the internally generated R&D costs up until the point of commercial production, which means that we have everything in place, it's applied, we've tested it, we know it's ready, we're producing, right? So once that occurs, then some additional costs after that point can be capitalized into an asset, right? Recognized as R&D expense. So these are all the things that we recognize as R&D expense. Any personnel costs, any materials, equipment, and facilities and intangibles that are procured for the research and development. We expense them unless they have future alternative uses. If they do have future alternative uses, then we create an asset just like we would have. But when we depreciate that asset, it's labeled R&D expense rather than depreciation or amortization. Interesting change, right? R&D fees when contracting with other companies for their R&D services. So maybe we don't do all of our R&D in-house. We hire a consulting firm or another research firm, and they help us. And that R&D expense would then be that expense would then just be an income statement item, R&D expense. Any indirect costs that should be allocated, general and administrative costs, for example, shouldn't be included unless they are clearly related to R&D activities. So unless we have a clear bifurcation of what is going into our normal operations and what's going into R&D operations, be careful about just putting, for example, rent expense, salary expense to R&D activities, unless it's clearly labeled. Exceptions. Firms that do research under contract, so those consultation or outside research firms, they will capitalize their R&D costs as a part of a receivable or inventory. Remember, construction in progress, so maybe they're on a 2-year contract with somebody to provide research over time. Then they would be able to recognize revenue, and they would have a construction in progress account by the percent of completion method. That is if they're going to be recording revenue prior to completion. And we should, of course, apply everything that we learned in Chapter 5, that lovely chapter that everyone just is so excited about because there are so many new and detailed things to learn. But that would be either a receivable or inventory for a client that records revenue in advance of completion. Capitalize assets and intangibles if they are purchased in the pursuit of R&D, if their future use exists. Again, remember that depreciation, just kind of this repeated down here. Remember that depreciation should be expressed as R&D expense until the start of commercial production. So after we reach that threshold of commercial production, they are no longer going to be recorded as R&D expense for that particular item. We would expense them by their alternate name, right? The name we would have used otherwise, like salary expense, lab cost, depreciation expense, or add them to the cost of inventory and process if appropriate. So again, this would be if it enhances the service quality, right? So we apply now the traditional capitalization procedure or capital expenditure procedure after the point of commercial productivity. Why is it expensed? Violation of the matching principle is expensing R&D out the gate, right? The reason why we do is we have a difficult time saying, all right, I've spent money on R&D this quarter, it's going to map into a revenue 2 years from now, right? Or is it 3 years or 5 years, right? A lot of research projects, I can attest to this directly, sadly, don't get off the ground. You have a great idea. You think it has to work. You have all the theory backing you on it. You run the numbers. In my case, you run the numbers and then nothing works and you scream and cry and go back to the drawing board. It is difficult to determine the magnitude of future benefits and the length over time the benefits are going to be realized. With science and certain projects, this is just part of the knowledge gathering process. Deficiencies in this idea, because we immediately expense it, we're not matching, right? Violating the matching principle, and everyone knows how much I love the matching principle. It's also a hindrance to companies that would be involved in this activity a lot, because one of their largest future benefits isn't going to be shown on the balance sheet, right? They're just pushing it straight through the income statement. There is empirical research that has been published that shows that investors do tend to capitalize at least a portion of R&D expense as if it were an asset when they value the stock price of a company that is heavily into research and development activities. So I didn't give you any room to do this, so I'm just going to label them off to the side, and then I'll provide like a little journal entry over here. But and we have BioCo, and BioCo is create a new pharmaceutical product. We had some expenditures during 2014. Say they paid employees in its R&D division $500,000 for the year. So if we have a personnel cost directly related to R&D, this would be an R&D expense. They purchased machinery for $400,000. It has alternative future uses. So because it has alternative future uses, we are going to capitalize machine for $400,000. That is not R&D expense. But at the end of the year, that was a $500,000 R&D expense. At the end of the year, we're going to charge some depreciation. But remember, we don't call it depreciation. We call it R&D expense for $40,000. We outsource some research issues to another firm. That's a fee paid to another firm, so that's $100K R&D. And we purchase rights to a patented process for $350,000. The patent will not have any alternative future uses. Damn. Then we have to recognize the whole thing as R&D expense. So what would the journal entry look like? You add up all your R&D expenses. You would have R&D expense of $990,000, if I added correctly. You would have a machine for $400,000. You would have some accumulated depreciation for $40,000. That represents the $40,000 of R&D expense that's included in that $990,000. And then the rest of it would have been a cash expense for $1,350,000. Right? The final item that we're going to talk about is software development costs. Software companies obviously can are highly reliant on their development of software systems for their own in-house use, but also for a product and resale, right? The costs incurred in the development of software products are going to be expensed, just like R&D project, until we have a different threshold, not commercial production, but technological feasibility. When technological feasibility has occurred for product software and internal software. So either way, whether we're using it in-house, whether we're selling it as inventory, this is the threshold we apply. The the definition of technological feasibility provides that the product can meet established design specifications and can be produced. And so this is a little premature to commercial production. Hence, the R&D threshold that is not software happens a little further down the line, right? So we can see capitalization of certain costs in software development, whereas if it were not software, we would still be recognizing those as R&D. Costs after technological feasibility are capitalized, so coding it, doing the trial runs, the production of the product masters, i.e. like prototypes sort of analysis. Again, this stuff, if it weren't software, would be still R&D expense. But since it's software, we have a little bit less of a stringent threshold. We kind of back it up and say, because of the nature of it, we allow them to capitalize a little more. At the software release date, we no longer capitalize those costs unless the modification extends the production quality or service life. So again, it's sort of back to basic capitalization rules. And the depreciation on developed software assets, so the capitalization that we do apply, is either going to be straight lined over the software's useful life or the ratio of its current revenue production to current and future revenue production. So a sort of proportion of the revenues it's creating this period. So it's a rather literal interpretation of the matching principle. We're going to take the greater of these two. All right. And finally, just one little blurb. IFRS differs slightly. They expense all activities related to research, but they allow the development activities to be capitalized on certain thresholds if they meet measurability and certainty, precision thresholds of, we can measure this. We have a rather good idea that this will extend or enhance the quality of the asset we're producing. And so IFRS is less conservative in capitalization of R&D. They allow it a little bit more than US GAAP. All right, so that's about it. I want to cover these problems in class, and I'll have another problem ready to go if we get through these, because it shouldn't take too long, but we'll see. I don't know. I'm all screwed up because of summer. All right, thank you.